In my last video, I showed you that beating the market is possible, but beating the market isn't about luck or getting rich quick. It's about having a repeatable, disciplined strategy. My strategy is built on three core pillars: growth, stability, and value. I'm either looking for companies that are on the verge of disrupting a market or for proven giants with a track record of being the best. But before all of this, the first thing I need to do is identify the great companies. Even some of the biggest companies that have had great performance over the last few decades can fall away from greatness. General Electric, Sears, American International Group, and two companies that might meet the same fate are Walgreens Boots Alliance and Paramount Global. This is a lesson that not all companies that are great stay great, and there is an even higher number of companies that are never great to begin with. How do I try and find the great companies to invest in? I have a 5-step process. Screening is a great way to narrow down the sheer number of investable companies in the world. I have two major categories of screener and then multiple subcategories that look for nuances. You will notice similar metrics at different values, which is why having the correct screen for the companies you're looking for is super important. My non-negotiables are a PEG below 2, to capture companies just above expected growth, ensuring I don't miss out on a perfectly good company like Nvidia. A debt to equity ratio below 0.5. It's an easy ratio to ensure a good balance sheet before further research. Then my soft constraints depending on the screen. Sales growth is a measure of how quickly a company is expanding its top line revenue. Consistent sales is often a leading indicator that the company's products or services are in high demand. While sales growth shows you the company size is increasing, EPS growth shows you that it's becoming more profitable on a per share basis. This is crucial for the shareholder value, as it shows the company is effectively translating its revenue into earnings. A strong return on equity shows that management is efficiently using the equity to generate profits. Once a company passes the initial screen, we look to go beyond the numbers and find a true competitive advantage. This is done through a qualitative analysis. This is how we understand the quality behind the company. How does the company make money? Do they generate consistent free cash flow and operating margins year on year? What is their competitive advantage? Does that competitive advantage create a moat? Could we even look at employee satisfaction, customer satisfaction, to discover if there's any positive or negative sentiment around this company as a whole? It is vital that whatever research you do, you always try and find contradictory evidence. This is to avoid any bias that you may come across. And then you can synthesize your research into a conclusion about what you specifically like about the company and if you are going to take it further. Once you have screened the companies and you've found a great company that you want to invest in through qualitative analysis, the next thing I do is a discounted cash flow analysis and a comparable company analysis. The DCF analysis must be good, stable, and bad cases. It should also utilize your qualitative analysis in step 2 to inform the decision-making process for the WACC and growth rate. Comparable company analysis is where you compare multiple rival companies to the one you are researching in terms of metrics. PE, PS, EV to EBITDA, and price to free cash flow are all valid methods. Finally, you can also perform a reverse DCF too. You use the current market price, your required return or discount rate, and the terminal multiple to calculate the implied free cash flow growth rate the market is currently pricing into the stock. Finally, journal your results. If you did buy into a company, it would be good to do a regular screen to ensure the company is working exactly how you expected it to. If you did not buy into the company, then it would be good to track the stock market price and some of the reasons why it is going up or down each quarter. Over time, with this type of data, you will see where your analysis is correct and where your analysis is incorrect, and over time you will start to become a much better investor. I applied these steps to monolithic power systems that I've been investing in now for around about 3 months, and I've recently added a position of KNSL or Kinsale Capital to my portfolio after determining that they were also undervalued. We can also see bigger companies like ASML, Google, and Nvidia meet some of my requirements. And after further analysis 3 months ago, I decided to also buy into these companies. Ultimately, this strategy isn't just about outperforming an index. It's about giving yourself the confidence to invest with purpose and not with luck. If you want to stop investing blindly, subscribe now and join me. Let's start building a portfolio that works for you.